Hello there. While we're still waiting to see if gold produces this intermediate cycle low, perhaps over the next several weeks, let's in the meantime have a look at the valuation of the top 3 largest miners, gold miners in the world, including Newmont, Barrick and Agnico Eagle. This valuation is based on their Q3 reports, as well as more recent updates such as the sale of Eleanor mine by Newmont. As usual in our model, we look at discounted per share value after all-in sustaining costs, long-term debts and taxes. And in our model, we only look at proven and probable reserve as well as half of measured and indicated resources, without taking into account any of the inferred resources, never mind any of further exploration success. So to the extent that the market price might actually correctly value some of the future potential success, the fundamental valuation presented here might be different. But as you see, we like to lean conservative here by looking at relatively more established reserves in the ground. And of course, the data that we plug into the valuation model includes the prices of gold, silver and copper, the amount of reserves and resources in the ground, the costs of extracting those reserves. We'll look at all-in sustaining costs, we'll look at long-term debts and taxes. Of course, we'll look at per share value with a discount rate of 5%, and we have a bit of a secret sauce on insider shares, as larger percentage held by insiders helps to align the incentives of the management with those of the regular shareholders. Starting with the reserves and resources that the miners have in the ground, for Newmont's gold we have 129.5 million ounces of proven and probable reserves in the ground, and that is after the sale of their Eleanor mine. Beyond the P&P reserves, they have measured and indicated resources of 103 million ounces. In this valuation, we don't include any of the inferred resources, again, trying to err somewhat more on the conservative side. Moving on to Newmont silver, they have 596 million ounces of proven and probable reserves of silver, and in addition to that, that's exclusive M&I resources of over 456 million ounces. Moving on to copper, proven and probable reserves of Newmont are well over 29.3 billion pounds. Additionally, measured and indicated resources of copper are over 33.1 billion pounds. Moving on to Barrick Gold, their gold reserves, P&P reserves, are at over 74 million ounces, with additional 103 million ounces in M&I resources. Barrick's silver reserves, P&P reserves, stand at 170 million ounces, and external to that, M&I resources are at 820 million ounces. Barrick's copper reserves, P&P reserves, are at over 12 billion pounds, and M&I resources of copper are at over 33.8 billion pounds. Next, Agnico Eagle, their gold reserves are at over 51 million ounces, and M&I resources of gold are at nearly 44 million ounces. Silver reserves are at over 55 million ounces, with additional over 61 million ounces in M&I resources of silver. For copper, Agnico Eagle has significantly less than the other two miners, with over 1.4 billion pounds in P&P reserves of copper and 228 million pounds of M&I resources of copper. Next, moving on to all-in sustaining costs, long-term debts and taxes. Newmont has unfortunately raised their target for their all-in sustaining costs for the year. They are now aiming closer to the upper boundary of that range for the annual guideline. So all-in sustaining costs have increased compared to their Q2 reports. Their long-term debts have declined a little over the last several months, down to nearly $9 billion. And cash has, of course, increased significantly, especially with the sale of their Eleanor mine. Cash now stands at over $3 billion. Moving on to Barrick, their all-in sustaining costs expectations have not changed since their Q2 reports. Costs still stand at $1,400 per ounce. Long-term debts are at over $4.7 billion, with cash at over $4.2 billion. And the all-in sustaining costs for Agnico Eagle haven't changed since Q2 reports either, standing at $1,220 per ounce. That's the lowest cost producer among these top 3 largest miners in the world. Agnico also has the smallest debts, long-term debts at less than $1.2 billion, and cash at $977 million. As for taxes, to keep things quick and simple, I assume a flat tax rate of 25%. Moving on to shares and time value of money, where we apply some discounting. Newmont has 1.14 billion shares outstanding with 0.09% in insider hands. As for discounting, we're going to apply the discount rate of 7% to all these three miners over their mine life, which is 20 years for proven and probable reserves at current annual production for Newmont. Adding half of M&I resources extends that mine life to 28 years. Next, Barrick, which have 1.75 billion shares outstanding with slightly more in insider hands, 0.61% in insider hands. Their mine life of proven and probable reserves is 19 years at current annual production, and adding half of M&I resources extends that to 33 years. Next, Agnico Eagle has nearly 502 million shares outstanding with 0.07% in insider hands. At current annual production, which is quite good compared to their reserves, they have a mine life of around 15 years. Adding half of M&I resources extends that to 22 years. So with all of these numbers in mind, let's correspond those to our gold price scenarios, where as usual we have three scenarios. The conservative scenario plugs in the gold price of only $2,000. That's quite a bit below the current level of $2,622. Balanced scenario plugs in the gold price of only $2,300. And even our optimistic scenarios, same as in the previous several video after Q2 reports, the optimistic scenario still stands at $2,600 per ounce, although current gold price is already above that. Before finally looking at the results of the valuation model, let me remind you that for much more detail on the valuation, other charts and tables regarding Dolly Varden, as well as a range of other very promising junior developers, make sure to join us at myfinanceteacher.org, and in particular check out that juniors in metals category. Beyond that, of course, we have the best uranium report on the internet. The most recent December report was recently published on our website at myfinanceteacher.org. And most recently, we published a fascinating discussion of a promising opportunity in real estate. Finally, let's have a look at the most interesting part of these presentations, the results of the valuation model. Here we look at the conservative scenario where we plug in the gold price of only $2,000. And in this scenario, we only look at the proven and probable reserves in the ground, without including any of the M&I, never mind inferred resources. That gives us the valuation of nearly $32 for Newmont, nearly $13 for Barrick, and $37.4 for Agnico Eagle. That is quite low, even given that the miners have underperformed gold itself over the last year or so. But again, remember, that's if we plug in the gold price of just $2,000 an ounce. Moving on to the balanced scenario, we plug in the gold price of $2,300 an ounce, and even in our balanced scenario, we're still looking at the value of only proven and probable reserves in the ground, without any of the M&I resources, never mind inferred resources, which gives us a value of $52 for Newmont, already above the current price, $20 for Barrick, and over $52 for Agnico Eagle. Here, compared to the balanced scenario, the current market share price is only higher for Agnico Eagle, whereas both for Newmont and Barrick, the current share price is even below the current balanced scenarios. Again, quite a bit of underperformance from the miners versus gold price itself. Although we are probably expecting a bit of a decline in gold price down into that intermediate cycle low, and back in, say, October, the market share price of both Newmont and Barrick was actually above these numbers here. Finally, moving on to the most interesting optimistic valuation, which isn't outlandishly optimistic at all. We plug in the gold price of only $2,600. That's below the price right now. And in this scenario, in the optimistic scenario, we look at the P&P reserves in the ground and we only add half of M&I resources, never mind any of the inferred resources. That gives us over $94 for Newmont, over $42 for Barrick, and over $88 for Agnico Eagle. Wouldn't that be nice? I wonder what you think about these numbers. Newmont, for example, will they ever reach, say, $100 per share anytime within 2025? Let me know down in the comments below. And of course, remember to hit that like button and share this video with your friends. Have a marvelous Monday. Bye bye.